to the Capital Discussions Market Analysis and Week Ahead. I'm Tom Nunemaker with Jerry First. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. And with that out of the way, Jerry, interesting day in the markets. I saw the, let's see where we're at now. The SPX is down 34.67, so quite a big move to the downside.
Yeah, we've got lots of volatility on the markets, and for those of you who are tuning in, let me go ahead and let me bring up my screen, share my screen, monitor 2. Tell me when you can see my screen.
Okay, I've got a visual. Tally-ho.
All right, so welcome back, everybody. Today is September 28, 2015. It's a little after 12 noon Eastern Time. My name is Jerry First, founder and director of Investors Education Network, also known as Traders Education Network, broadcasting here live every Monday on CapitalDiscussions.com for the week ahead. And yeah, for those of you who are been following me, there's a lot of things I've been talking about since the beginning of the year, and even before that, but specifically at the beginning of the year, we had the Swiss National Bank, Swiss Central Bank, unpegged from the euro, and ever since then we've been having ripple effects through the markets, and they are reverberating. The schedule, or at least the agenda here for the week ahead, is we take a quick look at the current markets and scheduled events. We'll dive deeper into the charts and chart pattern recognition. We'll look at the VIX and then your suggested or requested stocks, ETFs, indexes. We can drill down on those, and we can look at options and option opportunities. And as Tom said, there's no recommendation, strictly for educational and information. Also, as a reminder, this Wednesday, September 30th at 12 noon, we're going to start and kick off the Beginners Trading Group. So go ahead and register here on CapitalDiscussions.com. So real quick, let me get the calendar out of the way. I always watch this because I consider the calendar to be a potential excuse for volatility, as if we need some. And consumer confidence in Case-Shiller comes out tomorrow. The pending home sales disappointed this morning. I'm looking at the scheduled events, and then we're going to get to Tom's comment about what's going on with the markets today. Coming up on Wednesday, Janet Yellen speaks. How many of you had tuned in, and I do like participation, as far as Janet Yellen was doing a presentation on Friday or Thursday, and it looked like she either had a mini stroke or some kind of problem of some sort. And I've been talking about how most likely interest rates will stay flat until she's replaced by probably Stanley Fischer. And so we'll see what happens. Of course, we don't wish anything ill on anybody. But anyway, it'll be interesting to watch. And they've kept that relatively quiet. You have to kind of dig to see. You can actually see the video if you dig it up. So coming up at the end of the week, we have the the non-farm payroll report. Donald Trump just gave a speech where he's going to wipe out income tax if he's, it's Trump, T-R-U-M-P, tax reform under my presidency is the acronym, and he's going to wipe out income tax for anybody making less than $25,000 single or $50,000 as a couple. And but he was just talking about how the real unemployment level is probably at least 16 to 40%, and Carl Icahn, in fact, has endorsed him. And it's interesting that Trump is going to go ahead and recruit somebody such as Carl Icahn, I mean, that's an interesting combination there. So anyway, that's coming up at the end of the week. They'll be talking about that. But what's really affecting the market, in my opinion, is Glencore. Even though we do have a lot of other issues that could be affecting the market with volatility, the fact of the matter is the credit default swaps on Glencore are skyrocketing here. And they have been. The website that I go to, Zero Hedge, providing this information, has been warning and talking about how Goldman Sachs has been warning about Glencore because, and I have been talking about for the longest time, the ripple effects that you can't just go from 100 and this is the daily chart of oil over here. You can't just go from $62, $140 down to 30 some odd dollars, $39 in the commodity markets without having huge margin calls, because you've always got somebody supposedly on the other side of the trade, and so you're seeing these ripple effects here. I'm going to come back to these charts in a minute. But the credit default swaps are something that you don't like to hear about too much, because that's basically how Lehman and Bear Stearns and AIG started to crumble the markets back in 2008, 2009. The other issue here is for the longest time, people were talking about the petrodollar going to be able to take over from the U.S. dollar as a reserve currency. And it's interesting, I did a presentation yesterday in Palm Beach to a group of Chinese and people who are interested in China. And, it's interesting, their perspective, some of them have contacts back home, some of them have relatives and married to people from China. They're interested in, what does devaluation of the Chinese yuan really mean to the U.S. dollar? And some of them want to trade Forex, which I used to do a lot of. And it's all tied together because people wanted to go ahead and move away from the U.S. dollar to buy and sell oil, and the petrodollar was supposed to also be an alternative. However, something else that happened at the beginning of the year, not only was the Swiss National Bank depegged, but Saudi Arabia has gone through a huge tectonic shift. The king passed away, and there's a couple of brothers and cousins and other relatives there who, it's biblical in nature with sibling rivalries. And so Saudi Arabia, which was once very, very stable and solid, is now shifting in the sands, so to speak. So when people are looking for what's the reason for the volatility, I always say it's the ripple effects. You can see this is Glencore's homepage, and it's a picture of a hole in the ground, commodities, and that's really something for a lot of people here at Capital Discussions gravitate towards the futures markets, and the futures markets were really made to trade commodities, not electronic digits based on some index or a derivative of a commodity. And it's natural resources and commodities that make the world go around. When you have a company like Glencore that clears the futures and commodities, these ripple effects, you end up having a run for the exits. The discussion at the Chinese meeting yesterday, talked about how once you lose faith and trust in the derivatives, because somebody asked me a question, isn't the market a zero-sum game? How many people would say it's a zero-sum game out there? For every winner, there's a loser. For everyone that buys something, there's a seller. My answer is that used to be true, but that with futures, with commodities, and with derivatives and derivatives of derivatives, you can push the risk out into the future so that it's rehypothecated. And so So it used to be there's a winner for every loser and vice versa. That's not really true, especially for those of us who use options. You can, always see that as a way where you're pushing and morphing your trades out into the future and building option ladders and such. So it's just, something to think about from the big picture perspective. Now, these are the daily charts. This is a snapshot. You can see on the top row the euro versus the dollar, pound, and the yen. And notice the S&P and the Dow 30, these two over here. Notice at the right edge of the chart, we have this huge drop-off, and then it comes back up, okay? And obviously the indexes pretty much mimic each other pretty closely. Just remember that image, and I'll come back to that. This is oil on a daily chart. This was just a screenshot here at 11:04, just about an hour ago. You can see a beautiful triangle pattern right here. Very, very well set. And we could potentially zone in on that. I don't know how many people are actually trading oil futures or commodities. And then over here we have gold on a daily basis. And gold is trying to break above this trend line. If I could draw that. And, when you draw that trend line connecting those resistance levels, do we have a head and shoulder pattern? I don't know how many people say that that's an inverse head and shoulder pattern. There's a lot of people waiting to see gold spike. And there's so many ways you can trade gold, whether it's in the futures market or with the equity ETFs. And then you've got some people stacking, as they say. So let's go ahead and move over to the hourly chart. And you can see that we at one point had a regular head and shoulder, not an inverse head and shoulder pattern. And I measure these patterns from the head to the neckline and noticed that we had pretty much gotten about 3/4 of that target, the 78.6 Fibonacci being just about hit. And these lines were drawn for last week's presentation. And I can go ahead and update that on the live chart when we go to that. On the hourly chart, just look at the trend in general of the indexes, the S&P 500, the Dow 30. Notice that these trend channels, we did break on the Dow 30 to the upside last week, but a lot of that was due to Nike on the Dow on Friday. And overall, you have what's more easily seen is a stair-step pattern on oil, where you go ahead and you can see, let me get my pen here. There's your stair right there, and then it drops down, and then another stair-step down here. And so a lot of people would say that, well, we're making higher highs and higher lows. But remember, on a 1-hour chart, that's going to get overruled by the daily chart or the weekly chart. And sometimes that's just a setup for a breakdown through support. So let's take a look at the Dow 30 real quick. Remember, I was telling you before to just go ahead and look at these, look at this chart pattern here for a second. And if I move forward, you can see, the whole concept of chart patterns and pattern recognition is something that I'm pretty well known for. And you can see here, this is the daily chart of the Dow 30. And I'm focusing on the Dow 30 because I want to show you some historical charts. And so this huge drop-off on the daily chart followed by this run up, which for those of you who've been tuning in past weeks, I was predicting that we probably saw the ultimate fear for the short run come out and that we would rally back up. But I want you to go ahead and take a look. This is from the summer and fall of 2011 when we had a similar huge run down with an exhaustion move down, and then we rallied back up, but then it came back down again. And the concept is that we have these cycles, and I'm expecting potentially for us on the current charts let me get rid of this. On the current chart, I'm expecting that we could potentially be putting in a cycle. It might take a little while, but I'm expecting us to probably hit a double bottom here. Let me clear that. And for those of you who hadn't tuned in before, and those of you who have, I'm also looking at the fact that we have potentially a head and shoulder pattern forming here with a neckline. Notice resistance here, support here, drawing a neckline into the future. And we're well on our way for potentially building that head and shoulder pattern. So that's projecting into the future. When we have the beginner trading group on Wednesday at 12 noon here on Capital Discussions, you can register for that. That's when I'm really going to go into, the fact that when we are option traders, you have time, price, and volatility. And those are your three key variables that you're trying to solve for. And by taking any two of those, you end up with a formula that tells you that what you're trying to solve for. If I know that within time and price, I'm expecting price to do something like that, then I need to understand and project and figure out the best I can the ultimate unknown, which is volatility. It's easier to predict time and price. The actual volatility numbers can become a little bit more tricky. We'll go ahead and look at the VIX in a second. And this is the live chart right here. Hold on a second. Let's pull up the VIX. This is my live chart on the Dow 30. And you can see I do draw a couple of lines here and there. And so you can see that today the VIX is up about 10%. How many of you here are trading with VIX instruments? Anybody? Let's get a sound check at a minimum. If you can hear me.
Sound is fine.
All right, good. Thank you. How many of you are trading with VXX or notice if I type in VIX, okay, you start to see some of these. You got the VIXM, VIXY, VXX, VXZ, XXV. You get the inverse. I'm just curious. Tom says he trades the VXX. Interesting. How's that working for? If you don't have to answer if you don't want to, Tom. I'd like to get a handle on anybody. My concern is that usually when you see the VIX spike, it's going to spike and then it's going to crash back down. And then as I've been saying, usually it's just like when you're plucking a string, you're going to have these reverberations. Or as someone else was saying, it's like an earthquake with aftershocks. And I think that's what, at a minimum, that's what we're seeing. Nice 10% move up. What does concern me is that we have real legitimate concerns that, the Fed is running out of time and ammunition, and there's a lot of real financial and geopolitical issues that could roil the markets, and they could get out of control if we're not careful, or if the powers that be aren't careful. I think, for the most part, I think that the powers that be wants to keep things stable. But then again, all bets are off once, as Mike Tyson said, everybody's got a plan till you get punched in the face. And so the VXX, I'm not, I'd be curious to know, I don't know, Tom, has anybody come in? I know that I think Steve from OptionView talks a lot about the VXX, I believe. I think Glenn Yates builds some models off the VXX. What are the strategies? Because I personally stay away from it. I'll just go ahead and trade,
Yeah, I don't know, Tom, do you have time to come on the call? Maybe you can join in the chat or the conversation.
Back ratio. Okay, back ratio makes sense. You short the 27 and go long 33s. Interesting. Okay, if I had time, what I would do is run that through OptionView, or if does Tom, do you present every once in a while, or is he active in the other trading rooms?
Yeah, Tom's in my trading group too, and I think you're also in the APM trading group, right?
Does he use OptionView or OptionNet Explorer?
Yeah, Tom uses OptionView, I know.
Yeah, I don't want to put you on the spot, but I mean, if you're in one, or would you want to do an impromptu short presentation on your VXX strategy? Because I do see the volatility picking up, and I'm just sticking with what I know and what I'm comfortable with for lots of reasons. But I do know that there's some people who've been very successful selling VIX options over time. I have a feeling they're going to get their head handed to them if they're not really careful, if they haven't seen what happens when you have a spike. Got visitors at work. Tough to, yeah, not a problem. Maybe in the future, or if feel free to attend inside the beginners room and reach out to me, and love to go ahead and be exposed to some more strategies as far as the VIX instruments. But the bottom line, what I typically tell people is that it's a derivative of a derivative, and sometimes a triple derivative. And so I try to stay closer to something that's a little bit more solid, not just a synthetic. But all right. So let's go back over to the presentation for a second, and then we're going to dive into the into some more of your symbols and such, and the live charts. I do focus on the Dow 30 for a lot of different reasons. I know that a lot of you here are trading in the Russell. This software, which is free from dailyfx.com, the free charts over there, they don't have the Russell index. I can get the S&P, I can get into the international indexes, but for the most part, they mimic each other pretty closely. And there's some other reasons why I focus on the Dow. With this being one of them. Okay, so notice the cross. Some people call it the death cross. When you have the 50-period moving average cross the 200, certain funds have to sell or exit their positions. It's sometimes a lagging indicator. By the time the cross appears, a lot of the movement to the downside, a lot of the volatility, the downside's already been realized. So typically, I'm looking at the breaks of the 50-period moving average, and of course lower highs and lower lows, indicating the change of direction. And I look at my other supporting indicators last. just to go ahead and look for patterns in the indicators and also the momentum built into the different indicators. So, but here today, notice the NASDAQ composite. This was done at 11:22, just about an hour, exactly an hour. Is that, yeah, almost exactly an hour ago. And you can see the 50 and the 200 on the NASDAQ composite touching. And so there's another ominous sign to the downside. And one more chart here historically, just for fun. Here's 100 years of the Dow, okay? And notice just by connecting the tops to the top, notice the parallel lines here for the trend channel. And on a 100-year basis, a drop down to 11,000, going back to the 1930s, my Fibonacci extensions, notice from this peak back in 1929, 30, down to 1933, my Fibonacci extensions, there's a 4,000 and a 5,000. Isn't it amazing? The 5,000 Fibonacci extension called the top of this market. Notice the 4,000 extension called the top right here. Notice the congestion zone right here at 3,078.6. And notice that the 2,061.8 called the support levels right here. I mean, it's just amazing, isn't it? Fibonacci's. And so, again, here's a screenshot of the Dow 30, which I always like to make sure I've got a screenshot in case for some reason there's an internet issue or with my charts or something. Notice on the 30-minute chart here that we're inside of this trend channel that broke to the downside, and now we have the support level that price is looking to bounce off of around the 16,000 level. So, before I go out to the live charts, just one more reminder. We're going to have the new trading group for beginners starting this Wednesday, September 30th at 12 noon. Register now while it's free here on CapitalDiscussions.com. Go up to the well, Tom's going to send out a reminder. He'll send out a link for everybody who's logged in here. And one of the key...
It goes out the day before and then 30 minutes before.
Right. And one of the key things that I'll be focusing on in there is my charting, technical analysis, your basics of support, resistance, trend lines and channels, high probability chart patterns, the indicators, Fibonacci's, determining price targets, and then using software such as OptionView to help calculate my risk reward, my best option opportunities, and then enter the trade and get away. This slide goes back to 2011. I've been doing this for a long, long time. So, all right, with that, let's go over to the live charts. And glad to see that you log charts. So many people don't get that for huge price differences like that. Thank you. Thank you, Robert. And when it comes to, if you're talking about the logarithmic, one of the things that I talk about to people is a lot of people, they go out to their broker and they get their charts from their broker. And, you know, so here, come on, Thinkorswim. Here, for example, these are my market internals. And so you can see I'm tracking the DIA, the tick and the trend and the VIX. And let's see here. Where is my other one here? Well, the bottom line is that when you get these charts from your broker, some of them are pretty good, and they've gotten a lot better. And so if I wanted to go ahead and look at, somebody give me a stock symbol to take a look at. First person who types in a stock symbol is a winner. Amazon, good choice. All right. So here's Amazon, and here's the charts that I get here from Thinkorswim. These are some of my defaults. Okay, um, it is extremely cumbersome for me to go ahead and remove the studies, and I can't even merge these studies unless if they've made that enhancement, and eventually I just give up. And they do a good job of updating, but but the bottom line is the question, or the comment is, as far as being logarithmic and such, a lot of these charting programs, if you're not really an expert on learning how to adjust them, squint them, whereas here, this is the paid version of freestockcharts.com. Freestockcharts.com is pretty good for the price. And if you use Firefox, I found an add-on that actually takes out the advertisements. Get it while it's still out there. So if we take a look at Amazon, one of the things that I'm looking at is multiple time frames all the time. Had an article published in SFO magazine before PFG cratered and went under. Although I still see that, I don't know, SFO, somebody I think bought the archive, but and now they republish or use it as a marketing advertising. But you can see here the concept of the article that I did in SFO magazine was cascading time frame trading, where notice, for example, on this chart of Amazon, we have a very, very well-formed triangle pattern where price has moved up. It made a top inflection point, came down, hit a support level. We already had resistance and support here, and then it hit it again. So now we have 3 to 4 or 5 touches right there. Price goes back up, made an inflection point, comes down over here, goes back up, comes back down, hits this support level again. Then it goes back up, and now it's hit, and you can just connect the lines, and now we have this triangle pattern. Okay, so this is a weekly chart of Amazon. And my head and shoulder patterns and triangle patterns are like my favorite for using the cascading time frame trading strategy methodology, because then I'm able to go ahead and project into the future once price breaks above. And this is a very good example of a well-formed triangle on a liquid stock. It broke the resistance of the upper trend channel of the triangle. I can measure the triangle pattern, so I have a potential target of like right about here, which it hit. And notice that I had intermediate points where price would likely go ahead and stop before it continues on its way, or it could potentially, change course and direction. But at least I have my time and my price targets. And if you don't have a target, if you don't have a target in time, and if you don't have a target in price, trading options becomes a lot more difficult. Now, there are people out there that do it based on raw statistics and deltas and things like that, standard deviations, but I add those things to it. But using charting and technicals gives you this extra layer of high probability, and that's what it's all about. Putting the odds in your favor with higher probabilities. So the idea being here on a weekly chart, I have these targets. It's going to take time to get there. So if I know that on a weekly chart, it might take me from the time that it broke the resistance level right here, January 23rd, 2015, and if I know that basically we have about 1/3 the distance of the triangle, so right about here is my potential target to complete the pattern in June. So what's the midpoint between January and June? Would be around March. And that's where I would go ahead and plug into OptionView, some strategies for March and June. But then I'd also look at the daily chart. And on the daily chart, I would then be looking to say, all right, while price is trying to, and this is what you would have seen back then, right? We go back in time, and again, this is an example as to how different charting programs, once you become really good at manipulating them, these tools, just like a artist, can go ahead and really create a thing of beauty. All my lines, all my fibs, I love my fibs, and my moving averages and my indicators, and don't make fun of them. At least, well, anyway. I can make fun of myself sometimes, but take a look here. And so you can see the fib clusters up here, the moving averages being broken. Notice that in this case, we had such a very well-formed triangle pattern that if you were not positioned early, you would have missed the gap up and through the upper level resistance on Amazon. And notice that we had a fib cluster right up here at 345, which price had gone up to around 355, 360, came back down a little bit and retraced before it went back up on its way towards 380. Now, that's on the daily chart. For those of you who are actively trading during the day, well, this gives you opportunities to be in and out of something like Amazon on a daily basis. And so you have multiple price targets, multiple trades, multiple time frames, and I hope that you get that global concept, and then that strategy can be drilled down in a couple of different ways. Did a presentation in Las Vegas on that, and to several other trading groups around the country back around 2007, 2008. So looking at Amazon now, we can see that all those lines that I've got a client that was trading and asking me about Amazon a while back. You can see that we're inside this trend channel right here. And we're trading now at 504, which is this 178.6 extension. Let's go ahead and just grab this line right here. So here's, and we have a gap right here. That gap was filled over here. And so we're sitting on this ledge, on this support level, because we have this trend line right here. And that trend line is extremely strong. Notice that trend line comes back all the way out, back in time to 2013. So the next stop down is going to be like 480, 483. And then we also have this trend channel cluster back here down at around 436. When you take a look on the 30-minute chart, you can also see more closely the support level and how the trend line combined with the Fibonacci, the 161.8 extension at 482. So going from 505 to 482. Robert, let me ask you, are you bearish, bullish, neutral? Are you just looking to buy and sell calls and puts? Or do you like to do spreads? And would you, if you're looking, and do you own the stock? Do you want to sell covered calls against it? You know, these are all the questions that you have to ask yourself. And this is what I do all the time with my clients, where I'm asking them, you know, what's your opinion? I could go ahead and give you trades. I could go ahead and find trades that could be bullish in nature, bearish in nature, or I could go ahead and give trades that would be ways to enter a new long-term position. The beautiful thing about options, ladies and gentlemen, is that they give you options. And if you know what you're doing, options are less risky than if you're just buying and holding stock forever. So Robert's saying it's taken a beating today. Not sure why worse than broad market. Have a small equity position, but not enough to sell a contract. And that can be, yeah. So let's talk about this. This will be like a little preview for what we'll be doing inside of the beginner's room. I'm going to go into option view, pull in Amazon. You can see it's down $19 today. And one of the first things that I always check when I'm looking at a new position is the biggest unknown of all, the volatility chart. And what I love about option view is that Mr. Len Yates, formerly of IBM, has built such a very well-designed interface, in my opinion. And so you can see that the implied volatility percentile ranking is 92. What that means is that only 8% of the time on this daily chart have options been more expensive, is one way to look at it. And the other thing that I also do before I go ahead and start looking into positions is I would go out to one of my favorite websites, is FinViz. And with FinViz, what I'm looking for is earnings announcements. They seem to, just because somebody thinks, you have to be careful about earnings and earnings calendars. Sometimes, companies, they can announce almost at any time. They're not necessarily bound by the published date. They try to do it so that nobody gets surprised. But you can see that the earnings over here is currently scheduled for October 22nd after the market close. So that means that we've got about a little less than 30 days. And so upgrades up to outperform strong buy 700. So the analysts back in the summer were saying that they've adjusted it to buy and strong buy, but no recommendations. Those are relatively recent, July and August. So that's a vote of confidence. So one of the things, and again, the disclaimer is that these are not recommendations. In fact, let me just jump up to that for a second. Okay, so here's the disclaimer. None of this is to be construed as a recommendation to trade, strictly for educational purposes. And I love this one, only trade with money you can afford to lose. So let's go back over to option view. And so if we're currently at the 42.8 implied volatility, and over time, it's typically around 33.7, 33.2. So we could expect a reversion to the mean from 43 to 33. So that would be about a 10% drop. So the question becomes, okay, how do you feel about Amazon? Long-term, short-term? Do you want to own the stock? Do you want to own it synthetically? It's one of the biggest things that I like to do is rather than owning a stock outright, we're trading at 500, rather than buying, some shares at $500, why not control if we believe that it's going to go back up sometime in the future? Why not go ahead and buy the resistance or sell the support? And even the dog agrees. And so if we get like a 550, we're trading at 504. We're down $20 today, which is only 4%. We're sitting on a support level. So price can either bounce or break off a support level. So if you're bullish about Amazon, okay, and I'm not making that call, I'm just taking a hypothetical, because actually I like especially in a market with volatility picking up, I'd potentially want to sell support. Maybe I'd want to see if I can, how much premium could I get selling the 440s. But I could also look at seeing how much could I do by selling, let's say, the 550s. So on the 550 call, so the 550 calls going out before earnings, we're going to go ahead and, 555, the weekly, and I like selling the weeklies and buying, if I'm going to do calendars, I like selling the offhand weeklies, which notice don't have, this is the open interest. Here's my legend, by the way, over here. I have open interest in the top right corner. I have the market price over in the top left corner. I have the theoretical price. Theoretical price, I'm always checking to make sure that there's not a major difference. And in fact, sometimes I'll even go ahead with option view and I'll change that from open interest to the difference because I want to see if there's something that sticks out. And I can see that, for something like a $500 stock, a 5-cent difference between the market price and the theoretical price, 6 cents tells me 20 cents, not a problem. I can live with that. But sometimes I've seen some glaring discrepancies where I have to maybe change my volatility model. So anyway, let me go ahead and put open interest back over here. I want to make sure that I'm trading along with other people. And if I think the market's going to go down, 19 days, I could sell the 555, collect $2, and I could manually go ahead and say, all right, let's say I sell 10 of those, and let's say that I buy the 565. So that's going to give me about $15 a risk, $10 a risk, 555, 565. What's my risk-reward graph look like? Okay, so I'm profitable as long as we stay below 555.82, and it cost me about $9,000 to collect 800. But if this is something that you have a large portfolio and you want to collect $800 in a couple of weeks, and you could collect it potentially a lot quicker. If we have a downdraft in the market and Amazon gaps down towards 460 or something like that, you might be able to go ahead and just close out the trade early. So that's just one example of a vertical. As far as owning the stock, why put, let's say, 1,000 shares of Amazon? Okay, it's an institutional position, right? 1,000 shares, it's going to go ahead and cost you in margin requirements about $75,000. Cash requirements, $500,000. Okay. So $75,000 required in your account to go ahead and buy 1,000 shares right this minute. However, what if we were to go ahead and buy 10 of the 560s? That's for the January 2017 leap. And, hey, how about for an extra year, you just pay an extra $30? I mean, compared to $500, what's an extra $30 to control it through 2018? Looks like these leaps have just come out recently. So if we take a look at this leap here, and if we're correct, and we think that Amazon's going to go up, and if we think it's going to gravitate, remember, this is why you got to be good on the charts. If we think we're going to gravitate back up towards 560, and it could happen relatively soon, well, what happens if, I really like their calculator, if you buy the, let's just go ahead and let's do all three of these positions at one time. shall we? Okay, so here's the risk-reward graph, which is invalid. You know, for this purposes, what I'm going to do is focus on this calculator. So what happens if we go up to 555? We have a drop of about 10% in volatility, and it happens within 30 days because the earnings is going to come out. So it's T plus 30. Okay. So if you would have bought the 1,000 shares, it would have cost you about 75,000 in margin. Net requirements 503, but we're not. We know we don't have 75,000 though would have been required. Here, let's put cash requirements. Cash requirements. So they don't even. Okay, so the cash requirements isn't putting in the margin requirements, maintenance. It doesn't change the net requirements. Okay. So 1,000 shares, Amazon 503. If we went to 555 by October 28th, yes, we'd make $51,000. That's nice. But we risked 75,000. If we bought 10 of the 560 calls for $61, okay, that would be a requirement of 61,000. But see the difference in the net potential loss? 500,000 versus 61,000 of absolute, worst case scenario loss, which you might say that's not realistic, but trust me, I've seen companies be halted and collapse and gap, and just when you thought it couldn't go any lower, continue to go down. So although a lot of you may say that that's not realistic to look at a $503,000 exposure on 1,000 shares, things can happen. So looking at this absolutely, your absolute risk, 1,000 shares, $500,000. 10 contracts for the January leaps at 560, 61,000 of risk. 10 contracts for that 2018 560 call, 93,000 absolute maximum risk. You've got a boatload of time premium built into those. Notice that you'll collect about $37,000 if we go back up to 555, or $40,000 if we go up to 555. And so, so that's just one quick example. And obviously, yes, these are expensive options here, $61. But that's just one quick example without going into Trade Finder and really using and showing the power of option view. We don't have the time for that today. But that's one example as to what we'll be looking at doing during the beginner trader classes. October 22nd date is not confirmed yet. Let's take a look here. Amazon. Trade. Yeah, October 15th, 32 days. Well, no, October week 5. October week 4 should be 22, right? It looks like it's active in trading. There's an open interest. Robert says, which pricing model is the theoretical price based on? Okay, that's a great question, Robert, as far as the pricing model inside of OptionView, where the theoretical price of the option, you have to dig deep into the settings where you can go ahead and figure out if you want to, you change the system models and the default models, because you can go by between especially with something like Amazon. Notice that you've got a pretty wide spread, especially when you get up to the 560 range. So you've got trading, the bid is 915 by 985. So you can go ahead and add the 2, divide by 2. There's all kinds of different theoretical prices that OptionView will plug in as the base theoretical price. Because when you do get out there, the 560 call for week 4 in October, the 560 call, let's go ahead and bring in. So if we go over here to the 560 call, if I right mouse click and look at the market depth, you can see the bid ask is 915 by 985. And if I click on that 560, and if I say I want to buy it, it says that the sweet spot's about 950 to 985. Notice that OptionView is giving me 950. So especially, you know, all of this, for those of you who are beginners, the bid-ask spread and open interest is just such a huge consideration that has to be fully understood. When I'm selling options, I love selling options that have low open interest. When I'm using a calendar potentially, let's say if I was going to sell 10 of these and just for fun, I'd be buying the November standard contract. Notice the open interest is a little bit higher. And here's my risk-reward graph for that. Kind of looks like a butterfly risk-reward graph on the calendars. I've had some of my best trades doing butterfly trades where I'm anticipating on a volatility crush. And so obviously that's not a beginner topic for Wednesday's class, but I will be encouraging participation so that I can get a gauge as far as, you know, who's in the room, how advanced are you, and if I have enough intermediate people, I can go into more topics such as the spreads, but I'm going to try and stay within the boundaries of beginner concepts, and so we'll take it from there. All right. I meant that Amazon has not officially announced the next earnings date, October 22nd, educated guess. Okay, thank you. Okay. And I had mentioned that, that these are not hard and firm dates, but I've noticed that FinViz usually they're about the best when it comes to projecting the future dates. I'm not sure where they get their data from. I'm not sure exactly who draws these lines. Sometimes when they draw lines on the charts, I don't know if that's a human that did that or it's a computer-generated trend lines and analysis. One of these days when I have some free time, I'm going to give them a call, find out. But you can rest assured it's going to be somewhere around the October 22nd date, unless if there's some shenanigans going on. Amazon and Walmart and Alibaba should be interesting. So with that, ladies and gentlemen, what I'd like to do is, let's see, you can't see the chat window here. If you're interested in not only the free beginner trading room here on Capital Discussions, make sure you ask Tom or go up to the link on the Capital Discussions website. If you're interested in more of a personal one-on-one coaching and mentoring, you can go to Traders Education Network, click on the top banner, and you can go ahead and fill out this survey and get a free one-on-one consultation. After you fill out the survey, I'll be able to go ahead and figure out if we're going to be, a good match, and then we can take it from there. If you're interested in charting, technicals, options, even currencies, feel free to give me a call, send me an email, drop me a line, And with that, I think we're out of time. It's actually 1:04. And so I want to thank all of you for tuning in here for the Capital Discussions weekly webinar for the week ahead. Again, my name's Jerry First, founder and director of Investors Education Network, also known as Traders Education Network, broadcasting every Monday here at 12 noon Eastern Time on capitaldiscussions.com. Tom. There you go. Did I just make that up? Have you ever heard that one before, Tom?
Tom, it's pretty funny for me, so.
Yeah, that just slipped, yeah. Capitaldiscussions.com. Tom doing an excellent job of supporting all of us here, whether we're presenters or visitors to the website. You know, Tom, thanks again. And
well, thanks.
Very good.
Everyone for joining us. I'll get this in the archive as soon as I can, and we'll see you next week. And just watch your downside. Markets look like they want to keep going.
Yeah, we do have, it's a good way to go ahead and wrap things up here. We definitely, if we want to look at the S&P, we are definitely looking, here's my support levels, and it looks like we're testing the support, and we have some real reasons, in my opinion, to get into the bearish positions, which can actually pay off quite well, quite fast, but you got to know what you're doing. So
bearish vertical for a nice profit. So yeah, this is not a bad time to do some little directional bias.
Absolutely. Absolutely.
All right, everyone. Well, thanks again, and we will see you next time.
All right. Very good. Thank you, Tom, and everybody. Welcome and good trading. Be well. Be safe.
All right.
Over and out.